It is Money Tuesday, and we made it through the financial chaos of 2022. At least I hope you did. Inflation and increasing interest rates, just to name a couple of things. Perhaps this year could be better. Here to help us out, Marshall Clay with the Welch Group joins us for a 2023 investment outlook. Good morning, sir.
Good morning. How are you?
People who watched their 401k toward the end of the year last year did not want to look at it that much. So what's the new year looking like?
Right. So it's kind of a good news, bad news thing,
Okay.
I think, for 2023. So I think the uncertainty is likely to continue at least for the first 6 months or so.
Okay.
The Federal Reserve did a great job in bringing down some of the commodities inflation. I think a lot of our viewers have seen that, gasoline prices, maybe lumber prices, some other commodities have come down. There's still an issue around services inflation and wage inflation, which we want people to have higher wages, but it's putting a lot of strain on companies out there. So that could ultimately creep its way into the capital markets, at least for the first six or 9 months. So I would expect more volatility in the markets, maybe some more downside volatility as we start into 2023, but there's some opportunities as it pertains to that as well.
Okay, let's talk about those.
Yeah, so when we look at having a bias in the market, typically we want to be very well diversified, but I think this year particularly we want to have a bias towards really high quality companies and really high quality bonds and fixed income. So what do I mean by that? So I think you want to look at companies that have really strong balance sheets, don't have a lot of debt, they make a lot of money consistently over time. So think of the companies that provide goods and services that you need day in, day out. Think of the Colgate-Palmolives that sell toothpaste, the Kimberly-Clarks that sell toilet paper, Johnson & Johnson, Pepsi.
Companies you know.
Absolutely. Companies you know that can consistently make money through a tough economic period. On the bond side, I think there's some really unique opportunities that haven't been present over the last several years. You can buy really short-term bonds that they're more or less interest rate sensitive, and you can generate maybe 4 to 5% yields on those bonds. So I would probably be a little bit more shorter term, have a bias towards shorter term, higher quality bonds. And I think having a mix of those things is very important as we get through 2020. And then obviously the third thing, and this is probably the most positive thing I can say this morning, is that if you look at the historical returns of the stock market, about 97% of all 10-year periods, so it doesn't matter when you started, 97% of 10-year periods have resulted in a positive stock market. That number goes down to 90% for 5 years, but 73% of the time over a 1-year time frame, the stock market is positive. So the odds are in our favor almost every year when investing in the volatile stock market, but I think they may be even more tilted over the course of the entire 12 months, just because we've already come off a negative year. So there's some upside potential certainly in the market.
And obviously people watching now, depends on where you are in your retirement plan, how much this affects you one way or the other.
Absolutely. If you're a younger investor and you have a longer term time horizon, you can look more towards those 10-year periods where you say, I've got a 97% chance of coming to a positive outcome. Obviously, if you're closer to retirement or if you're in retirement, you need to play a little bit more defense, and that's where those more conservative leaning companies come in, bonds come in. So look through those 401ks, try to identify those particular investment products that have that sort of characteristics, and you should be fine for 2023.
All right, good advice. Thank you, sir. Good to see you, Marshall Clay. All right, we've been talking